I want to thank everyone for kind of joining for today. I'm really excited to dive into this topic. I've done webinars around a lot of other topics around cap tables and waterfalls and modeling. And this is kind of a new topic to cover. And it's interesting. I've done the cap tables for years, and I honestly didn't get a lot of questions around anti-dilution for years. And it's actually only over the last year or so I've started to get a lot more questions around what happens in down rounds and how to handle anti-dilution and those things. And so definitely been like, okay, now I have to actually kind of fully build it into the tools and do more education stuff around it. So definitely wasn't a big topic for years, but is at the moment. So today, a bit of run a show. I'm going to go through, I have some kind of slides we're going to go through, and also going to go through a spreadsheet. The slides and the spreadsheet are currently available. You go to foresight.is/dilution. It'll take you to a drive. You can download the PDF of the slides. You can also view the Google Sheet. You can download it. And you might want to wait on downloading or copying over the Google Sheet, just because we might make some edits and changes in today during the workshop. And also I have the worksheet completely open for editing so that you can see when I'm doing things, you can see where my cursor is and see the formulas I'm going to. Just please don't change it because it is completely open for anybody to edit. But this hopefully makes it easier for you to kind of follow and track kind of what I'm doing as I'm doing it. So my goals today is basically go through about anti-dilution. So a little bit about me. So one, I did my bachelor's in economics at University of Virginia, did my MBA in finance at Tepper School of Business at Carnegie Mellon. I actually currently live in Pittsburgh myself now. Done a lot of different things in the past. I used to work as a VC, worked as a entrepreneur in residence or investor in residence for Venture for America. Used to work on product and forecasting for a startup. Strategy consultant, worked as a professional photographer, worked in private equity, did a bunch of other things. But for the last 5 years, I've focused on Foresight. And Foresight basically is what I call a boutique product and services company, where I focus on financial modeling and forecasting for startups and funds. And I care about financial models because for me, there are ways for us to create tools to help us make business decisions. And I know there's the thing that commonly comes up around models saying, hey, models aren't right. What's the point? And I'm like, that's fine. The accuracy of models is not the point. Even precision can sometimes degrade our ability to use them for important decisions. The important thing for me is the process and using them, the analysis, not the artifact or the tool itself. Right. So there are things that we can use to help make decisions. And so everything in terms of how we build and understand and use always kind of goes back to that core goal. So today we have a couple of objectives I want to cover. One, I want to go through what anti-dilution protections are, and what they look like in documents and how to handle them. And I want to go through how to model the impact of anti-dilution protections. And then I want to leave you with a practical tool you can use to edit and play with to do your own models and trying to understand the topic. So first, a disclaimer, none of this is financial or legal advice. Not a lawyer, not a financial advisor, not offering financial or legal advice in this. Always work with quality professionals, attorneys on transactions. I have done this tons of times and always useful to use them. And then as a general note in this workshop, I'm kind of jumping into a more advanced topic on this. And so the framework of this is, I'm assuming you're familiar with modeling equity rounds, cap tables in general, what the terms and terminologies mean around valuation and how to do basic math around cap tables, assuming you understand how to model convertibles and those things. And so this is kind of an intermediate level session. If you don't know those things, I have a bunch of articles on the web, foresight.is/cap-tables. Bunch of articles you can read through that cover how to do a lot of the mechanics around this. I also teach a class on this where I cover all the stuff from basics to more advanced topics around cap tables and models and exit waterfalls. If you want to start with just a tool, foresight.is/cap-table, which many of you probably already seen before, but that's the core tool that I use to do a lot of the models there. It is a generalized tool for people to use to model a lot of this, and recently added anti-dilution protection into it. And I do want you to understand that the way I do a cap table, the way I do a model is just one way. It is not the only way. There are many different examples of how to build cap tables out there. And so I try to focus more on the core concepts rather than this is exactly the way you lay it out and do it, because there's a lot of ways to lay it out and do it. And I want people to understand the concepts. They can apply it to build their own models, their own cap tables, however they want to, or interpret anything that makes most sense to them, because there are many different ways that they can be laid out and done. Now, let's talk about dilution. Now, dilution, to frame this up, dilution is normal, right? And dilution basically refers to the decrease in ownership that comes, decrease in ownership of a company that comes from to existing shareholders, that comes from company raising money, issuing new shares to investors. And that's a normal thing, right? So when companies raise new capital, they issue new shares to companies and the total number of shares increases. And if you as an investor or a shareholder don't get more shares as part of that, you get diluted. You own a smaller ownership percentage. And this is normal. And it's fine, actually. If the price per share and the new equity goes up over time, then the value of your holdings should go up. Now, the problem comes in with down rounds. Down rounds is what happens when a company sells stock at a price that was a lower price than it did previously in the past. Technically meaning that when a company raises capital at a pre-money valuation that is lower than past post-money valuations of previous rounds. Now, down rounds may happen. There may be nothing you can do about it as a company in the situation, but they can be damaging to a company and investors from a psychological or a morale perspective, but also from a financial perspective. And so that's the kind of thing I want to focus on today and going through that. So anti-dilution protections and provisions are specifically clauses written into shareholder agreements that enable or protect shareholders from the impact of dilution, right? And there's basically two types of dilution that we're going to focus on: ownership dilution and value dilution. Ownership dilution is basically when your percentage of ownership goes down over time, right? So the company issues more shares, percentage ownership goes down. Value dilution is when the value of the holdings goes down, the value of the equity that you hold goes down over time. Now, ownership dilution typically have clauses like right of first refusals written in there as one protective element against anti-dilution. And anti-dilution provisions, the usual term there, applies to value dilution. Most typically applies to value dilution. Now, we won't talk a lot about convertibles. So meaning safes, pre-money safes, post-money safes, convertible notes. And the reason for that is like all the language here we're talking about is shareholders and equity holders. If you own safes or convertibles, you don't own shares yet. They're actually converted into equity shareholders. And so all the provisions and rights don't apply in the same way. At the same time, structurally, those investment vehicles have some degree of anti-dilution protection built into them, because they have terms that says, the share price that you pay to convert your dollars into shares is to be determined, and it's to be determined by the future. And if the price goes, there's elements written into it that says, hey, you get a discount rate of the cap. But if you're raising capital at less than those terms, well, then you're going to buy at that new price anyway. So structurally, they're built in so they have anti-dilution protection against value dilution in that sense. Not necessarily against ownership dilution, because that's a bit different in that sense, unless you have post-money safe. But most of what we're going to talk about here about this is around equity shareholders, right? Equity shareholders, shareholders will own basically like preferred equity. Now, there's a lot of different ways this clause can be written, and the link here is a great resource to flip through and see a bunch of different examples or clauses. There's so many different ways that anti-dilution clauses can be written. And it can be written because there's actually, on value dilution, there's a certain set of terms that are fairly standard. When it comes to ownership dilution, there's a lot of different ways it could be written. All right. And essentially, think of anti-dilution in that sense as it's a negotiated agreement between two parties, and there's a lot of different ways to negotiate how they work. And so this is why when we talk about anti-dilution protections in general, I think if you think that there are anti-dilution protections in your shareholder agreements, always read the agreements, because just like any other shareholder agreement, there are many ways in which they can be written. It's actually one of the core concepts when I teach around convertibles, is because the way that a convertible can be written, so how the way it converts into shares can be drastically different, right? And so you may think you have a standard term, but it can be actually written differently. And so it's important to read the documents. And anti-dilution, specifically, it's important to actually be able to read the documents and understand them. Now, going back to these documents, go back to these examples, there's a couple different things that these actions are doing. The first one is actually it's just an example of how to do like ownership dilution. Basically says, hey, the company can issue more shares of common stock, but if you do that, you have to issue more shares to the shareholders. And the second one kind of refers to the same thing. It says, hey, if you sell additional shares per share less than consideration paid, whatever, then the company has to issue more shares to the purchaser to adjust for that. And the last one actually is a bit different. There's actually a specific case of like weighted average anti-dilution, which is meant to guard against value dilution. And it basically says, hey, if the company makes subsequent financing at a price that was less than the price paid before, then you have to issue the number of shares concurrently with the dilutions, the number of shares, ensure the number of shares would be converted according to this formula. We'll go into the details around it. But what's interesting about it is that there's differences here between issuing new shares and change the conversion ratio, and we'll get into that. So let's talk about a simple example here. So imagine an example where you as an investor, you purchased 2.5 million shares at $1 each at about a 10 million pre-money, and you come out of it owning 20% of the company. And then the company is raising a new round at 8 million pre-money. So what happens? So in this scenario, there's two types of dilution that occurs. One, you have ownership dilution. The ownership dilution because the company's raising new capital at any valuation and issue new shares, and you have a lower percentage ownership. You also have value dilution in this scenario. You have value dilution because the new shares are being sold at an 8 million pre-money valuation, whereas before they're sold at a 10 million pre-money valuation, right? So you have two types of dilution here. So the normal thing, the cure for like ownership anti-dilution, right? That reduction ownership percentage is you issue new shares. Now, there is a term written in most shareholder agreements called right of first refusal. And what that does is that gives the ability for the current investors to purchase more shares as part of it. It says, hey, if you're going to issue more shares, I have the right to buy more shares so that I can maintain my ownership percentage. And there are some things that can make it like less exact. There's typically a thing called like carve-outs. Carve-outs meaning you can buy all the shares, but not all the shares. Like if you get diluted from options, new options, new warrants, and other things, then you don't have the right to maintain your ownership from those issuances. And not all investors will have those rights. Typically have to be a major investor, meaning have a minimum number of shares or have invested a minimum number of dollars to be categorized as a major investor to get those rights. What's the key thing to remember from this type of right is it gives you the right to buy more shares to maintain your ownership. The second way it's written is there's also a whole set of ways to write anti-dilution protection or ownership percentage, which basically says the company just gives you more shares, issues new shares so that it maintains a certain ownership percentage. And in this world, there's so many customized or negotiated ways to write it. You could write it so that the investor maintains or gets issued new shares up to a certain amount, up to like a cap, for example. Could be the right carries through up until the company's raised an aggregate amount of capital. Could be raised that if they participate a certain amount, then they get to actually get the rights. And there's so many different ways to structure that. Modeling that comes down to basically just reading the legal document, understanding how to interpret it, because there's a wide variety. There's a wide variety in how the terminology can be written. Now, if you have value dilution, going back to the two kind of examples we talked about before, ownership dilution and value dilution. Value dilution, the typical way you account for that is you adjust the conversion ratio, meaning you adjust the conversion ratio in which preferred shares convert in common shares. So to back up slightly, remember that one of the core rights or aspects to a preferred shareholder, what they own, is they have the right or the ability to choose where they want to convert their preferred shares to common or take their liquidation preferences in the case of a liquidity distribution or an exit. And so that's one of the core rights there. Now, typically, preferred shares or written agreement says, hey, one share of preferred share equals X number of common shares. And usually it's 1-to-1. When you adjust the conversion ratio, what you do is you say, okay, well, no, instead of getting just one share preferred, you get 2 shares of common or whatever the number is. And whatever the number is is dictated by how the actual clauses around the anti-dilution are written. And so then we'll get into that in a second. The important thing to understand around anti-dilution protections in this way is that you're not changing issued and outstanding shares. So remember, you have issued and outstanding shares, which is the actual shares that everyone owns. If you're adjusting the conversion ratio, you're not issuing new shares. So you're not impacting issued and outstanding. You are impacting fully diluted, because on a fully diluted as converted basis, the number of preferred would change. And so this is where it's important to maintain the difference between issued and outstanding and fully diluted. And we'll show you in a spreadsheet how this works and how to think about this. Now, I kind of tease this, but there's a few different ways in which anti-dilution or value-based or price-based anti-dilution clauses can be written. Basically, it breaks down into two major areas. One is full ratchet and the other one's weighted average. The basic idea behind full ratchet is it's the best opportunity for investors. It basically reprices all of your shares down to the new price. We'll get into the formula for that in a second, but you basically calculate the new conversion ratio. It's just, hey, the original equity issue price, which is whatever you paid for the shares before, divided by the new equity issue price, right, which is the price underneath there. And so that's basically by repricing all of the shares provides full protection and value to the investor. Now, that can be pretty damaging to founders, right? So full ratchet anti-dilution is definitely going to impact the fully diluted, like what a founder actually owns in the exit. So it's a pretty punitive type of anti-dilution protection, and it's not common or popular at the moment. Much more common you'll see is weighted average. And weighted average doesn't provide like full protection. It covers like some protection or some compensation in the situation where there is a dilutive down round. And so, and what you do in this case is there's a slightly different formula to calculate it. And there's basically two different ways to do it. One called broad-based, and another called narrow-based. Basically, the difference is that in part of the formula is like total number of shares prior to the round. And the difference is what you count as the number of shares, right? So narrow-based is, fully diluted shares prior to the round, not including options and warrants. Broad-based says you do include options and warrants. Narrow-based is a little bit better for investors. Broad-based is more popular at the moment, and it's basically kind of the standard term it's kind of used today. And we'll show the amount of difference between the two. Honestly, just varies about how many options and warrants you have as a portion of your total shares outstanding. Now, the way you think about the formulas there's a generic formula, right? The generic formula is the new conversion ratio. So the original conversion ratio is usually 1, meaning 1 share preferred goes to 1 share common. So the generic formula for calculating the new conversion ratio is the original equity issue price divided by the new conversion price. Now that the conversion price and conversion ratio is kind of a confusing thing here. It definitely tripped me up the first few times I learned this. But basically the way the mechanics works is you recalculate out the new conversion price, and the new conversion price is part of how you calculate the conversion ratio. Now, there's a few different ways to calculate the new conversion price. So we talked about full ratchet already. So the new conversion price, and then their scenario is pretty easy. It's just equal to the new equity issues price. So if they're issuing new shares, if you originally paid $1 per share and you're issuing new shares at 80 cents, well, it's just $1 divided by 80 cents. That gives you a new conversion ratio. Broad-based weighted average is a little bit different. It's a little more complicated formula. And this putting in words here on the slide doesn't really makes it seem probably a little more complicated than it is. In a spreadsheet, I think it'll make a little more sense. So the way we think about that in this scenario is that the new conversion price is equal to the original conversion price times, and it's basically like the way that most people write the formula. It's like A plus B divided by A plus C. And what that means is it's fully diluted shares prior to the round plus the number of shares that they would have received at the new equity price, raised for the amount of capital that was raised during the round, the amount they would have issued at the original equity price, divided by fully diluted shares prior to the round plus the number of shares they actually got. The difference between the two is, if you had bought shares, if you originally paid for shares $1 in the last round, the new round is 80 cents per share. You're going to say, okay, well, how much money was raised in that round divided by that $1 share of the prior round is like kind of the top denominator of the formula. basically says, hey, total amount that was raised in the round divided by the actual price that they paid in the round. And so the bigger the delta or difference in the down round, like the more impact it's going to have in terms of the adjustment around it. Now, I know that this is probably where the point at which we start getting a lot more questions about it. So this is the point where I want to actually kind of show the spreadsheet so we can actually start to understand this. So going back to the kind of framework for this, these slides and the spreadsheet are available at forexat.is/dilution. So you can find them there. And then the recording and stuff will all be available afterwards. Actually, you'll get an email about it, and you'll can see everything kind of working later. I saw there's a couple of hands raised here. I actually forget how to do the hands raised in here. I apologize. If you have a question, please just put it in the Q&A, and I'll answer it. That's the easiest way for me to help. Let's see here. So the way that the spreadsheet is laid out is there's a README sheet, and here there are basic details, so links to some resources that I have in explaining all the topics, and then also some background readings if you want to get in a lot more detail and hear the same thing from other people. I can get some examples. There's some other background resources for that. But first, I want to show kind of how it typically works in the scenario of just model out what a down round means, right? So we have this scenario here. We have an existing cap table or pre-financing cap table, and then we have a pro forma or forecasted cap table. And this is just a general way to lay out a cap table for here. I don't have all the details on here because I'm just focusing on the thing I want to learn about this topic right here. But that's kind of like the general kind of flow. And basically we're saying, hey, different shareholders going down in rows, and then what they own going across. So we have here founder, an existing investor, and options, and new investor. And so in this bot basically models out what happened in the first round. And this is going to this accounts for the basic inputs here. It says, hey, the amount of capital is invested, the pre-money valuation, the ownership percentage after the round, and the value of the investment for that existing investor. So they purchased 20% of the company in the round, and they invested $2.5 million. Their investment was worth $2.5 million. Now, the key things you'll see here is you see this column here for issued outstanding shares and the percentage ownership based off that. And we see a column for fully diluted shares and the ownership percentage based off that. Right now, they're the same. There's no difference between the two. There's no change to conversion ratios. There's no options or shares reserved for issuance options. There's no difference between the two. Now we have a new scenario here which says, okay, well, now we have a new investor that's investing, and they're investing, again, $2.5 million, but into a lower pre-money $8 million. So we calculate the new share price based upon that. And basically come with a new post money, and they're purchasing 23% of the company afterwards, and their investment's worth $2.5 million. They invest $2.5 million, they get $2.5 million. However, for that existing investor and put in $2.5 million, well, they pay $1 per share, and now the shares are worth 64 cents per share. And so, in the absence of any adjustments or any effects from anti-dilution, their ownership went down from 20% down to 15%. And perhaps just as importantly, or more importantly, the value investment went down from $2.5 million to 1.6. So a significant a 5% change in roughly 5% change in ownership, but a pretty drastic change in the value of their investment. And actually, from a founder's perspective, they without any anti-dilution changes, they got diluted down to 60%. But the value of their shares went up, right? Oh, I'm sorry, the value of their shares went down. I apologize. They hold the same number of shares at a lower price, but their dilution is normal, right? So they're normally not going to purchase new shares to the round, so their dilution went down, but it's because they raised more capital. Now, let's look to think about what happens in the case of like an ownership dilution, right? Adjustments. So same exact setup from a pre-financing cap table, and let's relook at a pro forma cap table for this. And so this one, basically, what I'm doing here is I'm calculating out. It's the same exact setup, except in this case, I'm giving the existing investors some new shares. And what we're actually doing is we're figuring out, okay, well, how many new shares do they need to get to maintain their 20% ownership percentage. And so there's a little formula here, which I'm calculating. I'll make this a little bigger, make it a little bit easier to understand. But I'm saying, okay, well, as part of this new round that's being raised, well, how many new shares do they need to be issued so they have 20% on a fully diluted basis after the round? And there's a formula to do this. You can either do this using circular references. You could just say it's 20%. One way to do this is basically it says, hey, I want to have 20% of the total. And then subtract out what I already had to figure out how many new ones you have to have. That's one way to do it. Or you could just say, you could make it so that this total number of shares is just equal to, 20% times this fully diluted basis. And that's one way to do it. And that's perfectly fine, I think. Circulars can create problems. And so, in simple scenarios like this, there's no need to use a circular reference. Instead, we can use a formula like this. And I don't want to focus on the algebra too much, but basically I'm saying, hey, how many shares it's fully diluted shares prior to round plus how many were being new issued during the round times this factor, 1/1 minus the actual ownership percentage I had prior to the round. And that's the 1/1 minus accounts for the dilutive effect of creating more shares of them. So they get 20% in the end. That part's a little complicated. I'd rather focus on the concepts more than the algebra. But if you want to understand the algebra and not use circular references, that is one way to do it. So in this case, if we do the adjustment for them, we're issuing the new shares as part of the round. The new investor is still, the new shares being issued to them is included in the calculation of price per share for the new investor. So this new investor, this amount, this price per share includes the new shares that are issued. And so at the end of the day, the new investor still buys their 23.8%. Their investment's still worth $2.5 million. But for the existing investor, the extra shares enables them to get up to still maintain their 20% ownership. Now, the value of investment still declines, right? So they have a number of new shares, but they're still, they still own. The value of their investment is still less than before. Ownership percentage adjustments like this, they don't deal with value dilution, deal with ownership dilution. Now, the important thing to know from this is with the extra issuance of common shares to existing investor, the one thing notice from what happens to the founder. So they went down from their 60% or so prior to it, or 80% prior to the round, and they would have gotten diluted anyway, but they got diluted an extra amount because of the issuance of the extra shares to the preferred investor. And so, all of the dilution that comes from issuance of new shares, founder bears that, not the new investors. And so they get diluted down from it. Does this make sense so far? They have questions. Let's see, questions kind of from this. Might be a chance for me to answer a couple of questions in the Q&A. Let's see here. Recordings, yes, there will be replays. I'll put it on, all replays from all workshops are actually available online. It's just forsot.is/workshops, but I'll email it out to everyone afterwards. But that's pretty easy. They'll be available. Recording will be posted afterwards. So let's see here. So rather than adjusting the conversion ratio, is it correct to have anti-dilution provisions and instead just issue more shares? That's totally possible. Talked about that earlier in one of the slides, basically. And there's, one of the even examples on the example slide early on, the example was written that way, where instead of adjusting conversion ratio, they issued more shares. It can be a little different. There's different reasons to do one versus the other, so it's definitely possible. But I find that adjusting the conversion ratio is, if we're using the broad-based formula, is the most common at the moment. But definitely have seen scenarios where the terms are written so that they issue more shares, right? So you can do all of the calculations that we're going to do can be applied in both ways, right? So the answer is yes to that. I'm going to answer, Anna's question. If the anti-dilution provision is triggered by a down round and the adjustment's not waived. And that's an important point there when I say that, is that remember that these are terms written in documents, but they can always be negotiated out, right? There can be scenarios in which a company has to raise more capital and the investors don't want the founders to be significantly adversely diluted because they feel they may impair their ability or desire to run the company. And there may be other reasons why they don't want to get diluted. So dilution clauses can be waived in fundraisings. So it's important to remember that everything can be negotiated around that. So the question is, does the dilution, if it's not waived, does the dilution also impact new investors or just the common founders? So it's going to impact, if the adjustment's not waived, then, okay, so is inclusion provision triggered by a downward and the adjustment's not waived. Dilution also impact new investors. So it's not going to impact new investors. So the new investors, the dilutive impact of the shares is going to be built into the calculation of the price that's paid by the new investor. So they're not going to get diluted by the additional rounds. I mean, they're going to, and it's the same way that you would do the issuance of like any convertibles or issuance of option pools. You can always do them pre or post, but the investors going to want to get the number of shares they thought they were going to get for their valuation. So you can actually do it either way. You could adjust the valuation to account for the dilution from it. But most likely you would just include those extra number of shares into the number of the share count that's used to calculate the share price that the new investors pay. It's a short explanation of a much longer concept that I do in some of the other classes around modeling equity rounds and such. But that's the part that doesn't dilute the new investors. So it's just the common founders or any investor that doesn't have dilution protection, which might be some shareholders of the same class if they're not a major investor and don't have anti-dilution protections or whatever. Depending on the way it's written, but it's not the new investors, and that's the important kind of thing from it. So and is your question baked into pre-money valuation? Yes and no. So the way you would calculate the share price, if you can actually see it in here, the way I calculate the share price here is, pre-money valuation divided by number of shares. And I'm assuming here that I'm including the number of shares that come from the new, how do I explain it? From the new shares to be included, I'm including it in the denominator. And that's the part by including those number of new shares are issued to them, including the denominator. I'm like reducing the effective pre-money, right? So there's an 8 million pre-money valuation around, but the founders aren't really getting 8 million because they're also issuing a bunch of shares and they're bearing the dilutive effects and the new investors are not. So this is like one of the core concepts I cover in the modeling equity, modeling convertibles classes, is around what shares you include in calculations of the share price. So by including the number of shares being issued to the new investors in the share price, the new investor is not bearing any dilution that comes from it. Only founders are bearing the dilution from it. That's the mechanic. You could also do this where you calculate out the value of the dilution, right? So the value of those new shares, and then reduce the pre-money, reduce the effective pre-money, and then just divide by fully diluted part of the round. The effect's the same, right? Just two ways to think about it, but both can work structurally. I find this way to be easier to explain, but there's definitely different ways to do it as well. Founder anti-dilution, I have seen it, right? I've seen agreements where founders have the right to be granted additional shares in the impact of that. I've seen agreements that gives founders the right to be issued new shares of any new round, right? Whether it's just diluted, right? Whether they raise capital and value the increase of price, they're not getting value diluted, but getting ownership diluted. I have scenarios that still gives them more shares to maintain ownership percentages. I don't think it's common, but I definitely have seen it. So it can be written. That's in the world of negotiate agreements between two parties or multiple parties. And so anything is possible in those scenarios. So let's see here. Do I know any specifics in regard when it comes to venture builder companies or venture studios? Basically the same. There's no real difference there in the scenario that I've seen in practice. A lot of times because venture builders or studios will often and also invest out of funds that may or may not be part of the studio. And so they would be based on the same terms and structures as like a traditional investment fund. It's basically the same anti-dilution practice. There may be more flexibility in agreements to give them additional shares in the absence, what happens in dilution. So there might be a bit more of that. I haven't seen enough specifics around that, but in general, in what I've seen with studios is they're really not that different from funds in that scenario. But I haven't worked with enough studios to say that I know the practice for all studios. I apologize. Can you remind us how you calculate the new price per share in both scenarios? Oh, so I think I covered this already, but the new price for the shares is just the pre-money valuation from the new round divided by the fully diluted shares prior to the round. Now, then the number of shares you include in that share count, that's the part that has some more flexibility in there. And I would say if you have more detailed questions around calculating share prices and those things, some of the foresight.is/cap tables, cap-tables, the one I linked before, there's a couple of posts in there which go into more detail in terms of how to do that. Let's see here. Isn't conversion ratio adjustment preferable issuing shares to professional complication of liquidation preference? Is issuing new shares to anti-dilution? That is one of them, definitely. So this is actually probably a good time to go into conversion ratio adjustments. So I'm going to start with the full ratchet anti-dilution. And I'll come back to that question at the end of covering the next kind of content. So full ratchet anti-dilution goes through same exact setup here, pre-financing, pro forma. Now the pro forma in this case, the big difference here is we're changing this conversion ratio. So we're not changing the number of shares issued to them, but we're changing the conversion ratio. So now there's a difference between this issued outstanding and fully diluted shares because of this conversion ratio. So in this scenario, I'm breaking out the calculations basically for right here. It says, hey, here's the original issue. The original equity price was one. Basically, that's the $1 that was paid per share here. The new purchase price is 64 cents. The original conversion ratio is just 1. So 1 share preferred goes to 1 share common. And then there's a new conversion ratio as part of this, right? So the new conversion ratio for this is pretty easy. It's just the original conversion ratio times original price divided by the new price. And so what you do is you have this fully diluted shares. I'm actually now taking the number of preferred shares they own times the conversion ratio to get to a new fully diluted shares. Now I will say that it's not done in here, but this calculation of the share price could be written to include fully diluted shares on an as converted basis. So it could be written. So this share count here is based off of fully diluted shares prior to the round. It could be written to also include the number of shares that are being issued new or on a fully diluted as converted basis. So it could be written to also take in, the fully diluted shares from this. Well, also another way to do it. Perhaps that's a little more exact. I'm just taking the difference number of new shares as part of that. So that changes all the math around. But it could be written that way for that as well. But that's the key. The key aspect of this the full ratchet is that it's adjusting this conversion ratio in a fairly simple formula. But the impact it actually increases. It brings the full value of the investment back to that 2.5 million. So the number of new shares that they own times the new share price, they now have 2.5. They invested 2.5 million before. They got, if they hadn't had anti-dilution, it would only be worth 1.6. Now it's worth 2.5, and actually increased their ownership percentage on a fully diluted basis. They own more as a percentage base than they used to. So the people who bear the brunt of this is the founders, and the founders are the ones that get diluted most from this, coming down from that 80% to what we'd expect in the 60%. Now they get down to 52%. So a pretty drastic change to the ownership of the founders. It's also one reason why it's not popular at the moment. It used to be more popular and more used. I've worked in startups around venture since the first .com bubble, and so I've seen a variety of kind of changes around this, but it's not as popular at the moment. Now, let's talk about broad-based weighted average anti-dilution. Same exact setup, pre-financing cap table, pro forma cap table. The difference here is how we're calculating this weighted average anti-dilution. So same exact setup on same setup for the new purchase price, same thing for the original issue purchase price. The biggest difference here is just a little more complication to the formula for calculating out the new conversion price. And what we're basically saying here is, okay, what's the biggest part of this is it is the original conversion price times, and then that R31. That R31 is the fully diluted shares prior to the round. Sorry, I wasn't showing it. So fully diluted shares prior to the round, that 12.5 million, plus the number of shares that they would have gotten if 2.5 million had been invested, and if they've been bought the number of shares off the old share price, they would have been 2.5 million shares. Then you divide it by fully diluted shares prior to the round, plus number of shares are actually issued. So they invest 2.5 million, but they only paid 64 cents. So they buy more shares. So that reduces the conversion price right below 1 and increases the conversion ratio. Now you'll notice it's nowhere near as dramatic as the full ratchets. The full ratchet up the conversion ratio to, like in this case, 1.8, whereas here it's only 1.09. So it's not a large impact. So, they increase their ownership percentage to 16% instead of 15, and increase their value of investment from 1.6 to 1.7. So they still got diluted, but they got some compensation for that happening. The other scenario is the kind of narrow base weighted average. And in this case, everything's exactly the same, except instead of using fully diluted prior to the round, you're going to use just issued outstanding prior to the round. And so I actually have 2 sheets in here just to include options and show the difference between the two. But all the calculations, everything else is still exactly the same explained. It's just remember that you're not going to include the options in terms of the total number of shares. Again, broad base is more common in my more common in most of the things that I've seen these days. Now, the important implication from this, and I'll use this as a lead from this, is that, one thing we didn't talk about is how this impacts liquidity waterfalls, right? Now, liquidity waterfalls is basically how we determine who gets what what happens in an exit or an M&A event or distribution of cash to all the shareholders. Now, one of the things that comes from when you're just adjusting the conversion ratio, the key is you're not issuing new shares, so you're not changing liquidation preferences, right? Meaning that you invested 2.5 million, you own a certain number of shares and a liquidation preference per share. And so when you adjust the conversion ratio, there's no change in liquidation preferences. You do have to include that test when you start figuring out what if the preferred shareholders should convert the preferred shares to common shares. So you would say, okay, well, if I get 1 share of common, then I'm making one decision to take my liquidation preference or convert to common. However, if I get 2 shares per common, then that decision may change a little bit. So one of the core concepts underlying how to do waterfalls is this test between, do I take my liquidation preference or do I convert to common, as from an investor's perspective? And so we just have to make sure we account for the conversion ratio as part of that. And I don't want to get into the details of liquidity waterfalls and how it impacts that, but I will say that the free tool I mentioned before does include a conversion ratio as part of it. So part of the share class, for each share class, you can include the conversion ratio in there, and that's used as part of the calculations and how it figures out, do I take my liquidation preference or do I convert to common? So I'm going to so this is probably another good time to get to some questions. Unable to find the same template. Yeah, the template's linked in the slides. This is the core cap table template. This is listed on the site. This thing we're using in the class is not listed on the site, and it's at the other link that I shared, the foresight.is/dilution. So it's linked in all of the materials. Should be pretty easy to find a link to that. Let's see. So this is back to the comment by First Capital Partners. Isn't conversion ratio adjustment preferable in issuing new shares due to potential complication and liquidation preference if you issue new shares due to anti-dilution? The answer is yes, right? So if you issue the new shares, I mean, then it could be argued that their liquidation preference were not part of it, and so by increasing liquidation preferences, they create more preferences in the stack for a founder to have to pay back before they can actually take a distribution of common. Now, it can be written, the documents could also be written so that any issuance of new shares adjusts the liquidation preference, or doesn't, you don't get liquidation preferences for it. So you can also just write the terms different to account for that. That same thing used to happen around convertibles. So we used to convert, we used to have say you had a 500K convertible and the convertibles converted into shares. Many documents used to be written so that so that 500K got a discount, whatever, and converted into 625,000 worth of shares because you bought shares at a lower price point than the new investor. So it used to be written so that the liquidation preferences actually went up from what you actually put in 500,000 to the 625 because you got X number of shares at the X number of liquidation share price for those number of shares. Many documents now are written differently so that you don't get that. You don't get that bump in liquidation preferences for that. So documents could be written so that any issuance of new shares out of that doesn't do that. However, it's also going to like voting and control. If you issue new shares, changing the conversion ratio, the way the documents can be written, it may not change the voting rights per classes of shares. If you issue new shares, it creates a little more complicated. So it creates more complications around that. Conversion ratio is usually a pretty easy way to do it for that, for that particular type of anti-dilution protection. Can you explain the difference in repricing a prior financing prior to investing versus experiencing a down round, or would there be a similar event? I'm not sure I understand from the question is repricing a prior financing prior to investing. Repricing a past investment is effectively full ratchet. Means a full ratchet basically says, hey, I'm going to take all these shares that you bought for $1 and I'm going to now reprice them to the new equity share price. That repricing is effectively full ratchet anti-dilution. Now, if you just reprice them, like you can reprice it, but then you have to do some adjustment either to number of shares or to the conversion ratio to actually get the impact of it. So my guess is there's a couple other things associated with repricing. But in general, I think that there's a colloquial term that's kind of used there that probably doesn't explain the full impact as part of it. I think that might be I think that might be underlying the question. The question around safes at various caps. I covered this in one of the early slides, but this doesn't apply to safes, right? Meaning that, so remember that pre-money safes and convertible notes are a little bit different from post-money safes. But remember, built into the structure of safes is that it's not determined what the price you pay is. So if you own a safe, you don't own shares yet, so you don't have any dilution from it yet. So all these apply to shareholders, not value holders. Effectively, is what safes and notes are. Built into the structure of it is to say, hey, I don't know what the share price that the safe or the note's going to buy the shares at. So hey, here's some terms around it. I'm either going to buy the shares at a discount to whatever the equity price is, or I'm going to pay the minimum of whatever the cap is or the amount they raised at. So if they raise money at less than the cap, well, then you're just paying the new equity share price. So you're not getting diluted because you get to buy at the new share price. Now, pre-money safes and convertible notes still bear ownership dilution because when you issue new, so all safes are going to bear dilution from issuing equity rounds. Pre-money safes and convertible notes will get ownership dilution from issuing more pre-money, more safes and more notes. Post-money safes are protected from ownership dilution from issuing more safes and notes prior to equity round. It's built into the structure of how a post-money safe works. You still get diluted from the new equity round, but you won't get diluted on an ownership basis from doing more of them. So that's why they're different aspects and way they're written, but basically all the core concepts for anti-dilution don't apply to safes and notes in the same way because they're written, the way they're written is partially to kind of address that. One question here is how different types of pay-to-play scenarios affect dilution. Now, one important note about that is that, so I didn't really talk about pay-to-play, or I kind of did, but oftentimes the way that the terms are written around anti-dilution is that because they apply to existing investors prior to a round, the terms could be written so that you have to invest in the new round to get the anti-dilution on the previous round. Like you may not just get it automatically. You may have to actually invest in the new round, meaning pay to play, to get the anti-dilution protections. And so it doesn't, from a modeling perspective, it doesn't affect the calculations a lot. It's basically, hey, do they get anti-dilution or not? And then you can calculate out the amount they're raising as part of it is buying the new share class, right? So that's pretty straightforward math. But the concept that's important to understand there is that the investor, to get the anti-dilution protection, may have to invest in the round. Going back to always read the agreements and know how to apply the dilution in these scenarios. I see many situations where a university or incubators take up so much equity before the company raises that the founders have too small ownership to kind of make it investable. How would you fix this? Issuance of new ESOP shares and grant back to founders in one way, but there are other dilutive approaches. Yeah, I mean, there are other ways. I've seen scenarios where like they just decide to issue new shares or issue new ESOPs. That's the more common way. You could create phantom stock or other ways or off cap table to do it. The most common one I see is just giving new shares. And that happens even when you see the same scenario happen in like when companies bring on new management, for example. If they have old founders that had a large ownership percentage that leave and they bring on new management, they have to create enough shares for like the new people to coming on. So they have to do something around issuing new common shares or really just create a new ESOP to do that. But that's the majority of what I've seen in those scenarios. As SAFEs convertibles typically have a discount, they're giving 2 PPSs in the round that includes them for new capital for SAFE convertibles. Yep. What PPS are anti-dilution calculations based in these scenarios? So I kind of covered this before. So it's good. The PPS pay for safe equity is what they pay, right? You're going to use the calculation. You're only going to use the PPS paid for the new equity as part of it. I guess if you're doing the anti-dilution protection if you're doing anti-dilution protection for shares that were originally paid at an earlier price, for those investors, you would want to use the price they paid. I'm assuming that's the way you'd want to do it. Because ultimately it all comes back to like, what price did the investor pay? And so the investor, that scenario, if it was a safe investor that converted around, they pay a different price to equity investor, you're going to want to use the price that they paid as part of their calculations of their anti-dilution protections. This is where I beat derelict if I didn't mention that. So I know we have a couple more minutes and I'll answer a few more questions. But if you have more questions around this topic, there's a bunch of stuff on our website about cap tables and all stuff in general. And I'm always happy to answer questions if you email me. I also do teach a class on the topic where I go in depth in some more basic fundamentals around cap tables and then more advanced stuff around convertibles and option pools and proratas and how to handle exit waterfalls. Next class starts not next week, week after. And it's a four session class with case studies, mini case studies and a full case study and lectures and slides, and somewhat similar to how I do this, but a lot longer. And if you have questions around this class in particular, email me, happy to help. But what I always say is like, I'm always happy to answer any questions you may have around cap tables, how to handle all this stuff. I enjoy interacting with people and answering questions around this and learning from people's situations as well. So if you have questions around this, feel free to ask anytime. This is what I do all day, every day. Any last questions before I leave today? Yes, I do consult, and there's the these details a few services that I do, but then I do other services around this all the time as well. So there's no other questions. It's probably a great time to end. Thank you everyone for showing up today. I really, really appreciate it. And happy to help. Cheers.